Is a mortgage banking crisis taking over America? That's the question that I keep asking myself when I review this monthly data that I'm going to talk about in this video that comes from the Mortgage Bankers Association, because it's painting a very bleak picture for the future of the U.S. housing market by showing that mortgage originators and lenders of all types, whether they be traditional banks, whether they be an online lender like Rocket Mortgage or an investor, they are the most pessimistic they have ever been about lending and originating mortgages. That's right, especially when it comes to originating Fannie Mae and Freddie Mac qualifying loans. Banks and lenders of all types are simply saying, we don't want to do it right now in the summer of 2021. And this stands in stark contrast to the broader perspective of the housing market, which is very positive. I mean, home prices are the highest level they've ever been. Appreciation is the highest level it's ever been. We have all these people saying that millennial demand is going to burst through the seams, that the housing market's going to continue strong for years to come. Yet for some reason, lenders and banks are operating as if we're in a housing crash already. And so we're going to start things off with a graph like we usually do. And luckily, this graph is very, very simple. We're only looking at two lines here, two different variables. The yellow line is the typical price of a home or typical value of a home as reported by Zillow over the last decade in America. And we can see that the typical home value in July 2021 is $299,000. That's an all-time high. It's up 15%, 16% year over year, and way above the levels of about $160,000 back in 2011. Now we're comparing that home price, the yellow line, to the blue line, which is the level of mortgage availability. This is a data set tracked by the Mortgage Bankers Association. Essentially shows how easy it is to get a loan in America. And when this mortgage availability index goes up, just like it did from about 2014 to 2019, that means it's easier to get a loan. But when it goes down, just like it's done over the last 18 months, that means it's now harder to get a loan. Banks are demanding higher credit scores, more income verification, and are just generally more resistant to making loans. And the relationship between these two variables historically is very interesting, because if we go back to 2011, 2012, we were still in the midst of the last housing crash back then, and you could see both home prices, the yellow line, and mortgage availability, the blue line, was low. And that made sense, right? We're still kind of in the last housing crash, and as a result, prices were low, and banks were very hesitant to lend because they got burned in the last housing crash. But then, as 2013, 2014, 2015, 2016 rolled around, mortgage availability really started to increase. And it kept going up, up, and up to about a high in late 2019. Although, to caveat, it was not nearly as easy to get a loan in 2019 as it was, say, in 04, 05, 06, not even close. It was just that kind of banks returned to a more normal level of lending in 2018, 2019. But then what you could see on this graph is that over the last 18 months, ever since the pandemic, mortgage availability has cratered. Now in July 2021, we have around the same level of mortgage availability as we did back in 2013, which means that banks are very strict right now in terms of giving mortgages. You better have really good credit. You better have ample income. You better have no blips on your employment history. If you have self-employment income like me, good luck. A lot of banks aren't even considering self-employment income. So you got to be a perfect borrower to get a loan right now. And this is very interesting because over the same time frame, home prices have just kept going up and up, all the way to that $299,000 level, the highest of all time. And it's really the gap now that's developed between the yellow line and the blue line that's extremely curious and really concerning, that home prices managed to keep going up, yet bank lending is at its lowest level in 10 years. If that's confusing to you, that home prices keep going up and up when banks are more cautious, you're right to be confused, because that is a counterintuitive result. Normally, the mortgage industry and the bullishness of the mortgage industry should align with the bullishness of the housing market. But over the last 18 months, we've seen a tremendous divergence where the housing market more generally seems to be doing great, according to many people. Home prices are at record highs, inventory is low, prices are going up by record levels year over year. A lot of people over here are saying, wow, the housing market's so healthy. But yet then we have banks and mortgage lenders over here who are saying, wait a minute, something's not right about this. We don't really feel comfortable making loans right now. So we're only going to make those loans to the most super qualified borrowers who we are positive will pay us back if something goes wrong. it's almost like banks are predicting that there's going to be a housing downturn. But we'll get more into that in a second. What I really want to start off with here is by giving more data and definition about just how impactful the mortgage industry is on the housing market, understanding just how many homes are sold in America each year and just how many of them require mortgage financing to complete the transaction. And that's what we're looking at on this page here, where we're evaluating first the number of homes sold in America each year. And that's a figure that's about 6.5 million. There's 6.5 million homes sold in America each year, and those are comprised roughly 85% of existing homes being resold and 15% of newly built homes being sold to their first owner. So 6.5 million. The number could go up or down a little bit depending on the year, but that's about what it averages in the long run. Now, of the 6.5 million, roughly 1.3 million or 20% are purchased in cash. That's right. So 20% of all the transactions, all the purchases in America in a given year don't require a mortgage. The buyer has enough cash to just complete the transaction and pay the full price. So 20% are purchased in cash. And of course, that means that the remaining 5.2 million or 80% of transactions are financed with a mortgage, meaning that, we require a mortgage in order to facilitate this transaction. And it's with that you can see that what's going on in the background in the mortgage industry is really, really important, because mortgages in the end and the mortgage industry and banks, that's the engine of the housing market. And I think some of you might be surprised by that data. I know I was at first, because when I saw that 20% of transactions were in cash, I thought that was a little low, because all we seem to hear about in the news is big institutions like BlackRock buying in cash or foreign investors from China buying in cash. There's a lot of like boogeymen being propped up in the news, these cash buyers coming in, swooping houses out from under the noses of Americans. But when we look at the data, we see that even if that is happening to an extent, it's a small percentage of all the transactions for homes in America on a given year. 80% of them still require a mortgage. And so now when you start thinking about that decline in mortgage availability, you start seeing some real potential headwinds and concerns from the housing market going forward, because if banks are hesitant to lend money to people, then that could cause severe issues on the demand side of the housing industry. Even if, because of low mortgage rates, people want to buy a home, banks might not let them do that, because the mortgage qualification criteria are so high. But before we get more into that, I want to explore deeper into the mortgage industry, because there's some key things that you need to understand about where these loans come from. Because there's 3 specific buckets of different mortgages that are originated in America, and understanding these buckets is very important to understanding the overall demand for the housing market. And so we're back here on this page, and you can see we have our 5.2 million mortgages used to finance purchases in a given year in America. And these mortgages are broken down into 3 main different buckets, as I just said. The first is conforming loans, which account for 60% of all the mortgages. What's a conforming loan? This is one that meets the criteria set by Fannie Mae and Freddie Mac for mortgage origination. And typically conforming loans, after they're originated by a bank, they're often sold to Fannie Mae and Freddie Mac after the fact. And this is really the engine of the U.S. mortgage market. 60% of all mortgages are conforming loans that end up being sold to Fannie Mae and Freddie Mac. Next, we have government-backed loans, which account for 25% of the housing market. This can be a little confusing, because you might think government-backed, that's the same as conforming Fannie Mae, Freddie Mac. No, it's not. It's different. So government-backed is referring to loans that come from the FHA, the VA, and the USDA. And these are typically to lower-income borrowers with really low down payments. So the down payments on these government-backed loans are typically only around like 5%, and often there'll be some type of income threshold needing to be met to qualify, or it's strictly for first-time buyers. So that's the government-backed loan segment, which is 25%. And then finally, we have other/non-conforming, the remaining 15% of the market. And this is basically privately issued loans. A lot of them are jumbo loans, which means that the loan amount is above the conforming loan limit of $550,000. Others are subprime loans at high interest rates. And the thing to take away from that is that the majority of the mortgage market in America is backed by the U.S. government. 60% of mortgage originations are conforming loans that can eventually be sold to Fannie Mae and Freddie Mac, U.S. government agencies. Another 25% are government-backed insured loans that come from the FHA, VA, and USDA. And only around 15% are completely kind of like privately issued. And it's really, really important to understand that, particularly related to conforming loans. Because as we just talked about, conforming loans, those are the number one, the big kahuna. 60% of the mortgage industry, almost 50% of all U.S. home purchases are funded by these conforming loans. So what happens in that conforming loan segment is extremely, extremely important for the health of the housing market and the durability of that market going forward. And the unfortunate thing that's happened over the last 18 months is that conforming loan lending criteria has become so strict, like extremely strict, even stricter than it was in 2011 after the last housing crash. It has actually never been harder to qualify for a conforming loan in America than it is right now. And you could see what I'm talking about on this graph, where we're again looking at the mortgage availability index from the Mortgage Bankers Association, but instead of looking at the entire mortgage market, which include all of the types that we just described, which we did in the beginning, now we're looking at just the conforming loan index, just the loan segment that's backed by Fannie Mae and Freddie Mac. And again, the higher this index is, the easier it is to qualify for a loan. The lower the index is, the harder it is to qualify. And we can see that over the last 10 years, it's really been pretty stable. The mortgage availability for these conforming loans, which make up a majority of the housing market, around the 90 to 100 index level. But oh boy, starting with the pandemic, mortgage availability for conforming loans just completely dropped off a cliff, all the way in July 2021 to an index level of 51, which means that literally mortgage availability for conforming loans today is half the level it was in 2019 and also half the level it was in 2011, 2012, 2013, which is wild to think about. That from a bank's perspective, they are more hesitant to lend and make a conforming loan now than they were after the last housing crash. And it's hard to kind of wrap your head around that because it's so counterintuitive compared to the mainstream narrative of the housing market that we see reported, that the housing market is healthy and robust and demand's going to be coming for years and years. Yet conforming loan lenders are acting like we're in a worse situation now than we were in 2011 in terms of the housing market. They are acting like we are already in a big housing crash. It's important you remember that. Lenders, in terms of their lending standards and requirements being strict, they're operating under housing crash level circumstances when it comes to those lending standards. And this has really got to stop and make you think, what do these banks and these lenders know that other people don't know? Because if the housing market was legitimately strong and the underlying economy legitimately strong, banks would probably be back to their 2018-29 levels of lending. Yet, it doesn't seem like banks are trusting either the current housing market or the current economy or some combination thereof. Banks appear skeptical, and thus they only want to make loans to the super qualified borrower who, even if home prices decline by 20 or 30%, they say this borrower, their credit score is so good, they have such strong income that they're going to pay us no matter what. But even then, even some super qualified borrowers are now being rejected from loan applications for seemingly no reason. I see a lot of you guys comment about this in the comments, and actually I'm getting a lot of emails now from people who are telling me their stories about having their loan applications be rejected for no good reason, even though they seem like a really strong borrower. Let's take a look at an email I received last month. And so here's the email I received. I'm going to read it to you. I'm going to go through it slowly. Nick, I kept getting postcard pitches from my HELOC lender about their new HELOC interest rates. I asked if they would just lower the rate on my current loan. So I guess instead of taking a new home equity line of credit, This person just wanted to refinance their existing loan, which is at a 4% rate at whatever the prevailing rate was today. They said I would have to apply as a new customer, so I did. This person says that they have 15 times the loan request in marketable securities and a mid-8-figure net worth with very little debt, as well as a credit score of 844. So this person has literally a net worth of over $10 million and an 844 credit score, and so they applied for a refinance on their home at a lower interest rate. They turned me down. Mind you, I already have a HELOC loan for the same amount with the same bank with 3 years left on it, and we have had it with the bank for 20 years, always in good standing. What does that tell you about banks' willingness to lend? Wells Fargo has canceled all personal lines of credit nationally as well, which is kind of a separate thing. But so here we have this person who has an 8-figure net worth, 844 credit score, and yet they were denied their refinance application from their existing lender who they've had for over 20 years, good relationship. And I've been hearing and seeing more and more of these stories crop up over the last couple months where actually banks still kind of do the marketing for, getting a new loan, but then somewhere in the process, it just doesn't work and the application gets rejected, or the bank finds some crazy small reason towards closing to say, hey, we can't do this, or to what's called retrade the borrower, which is renegotiate terms, make the loan amount lower and require more equity. I've been hearing a lot of stories about this stuff, and it really lines up with the data from the Mortgage Bankers Association, which is showing that lending standards have gotten so strict over the last 18 months. And so the question to ask here is, what's going on? Why are banks so hesitant to make a loan to the person that I just showed you in the email? Why are they so hesitant and strict with their lending standards, as I've shown you with data from the Mortgage Bankers Association? Something doesn't add up with what's going on in the housing market more broadly, and that's what's going on with banks who control 80% and finance 80% of all the home sales in America. Now, I think one question a lot of you are probably asking is, why are banks behaving like this? Why are they acting so weird in terms of loan requirements and making new loans when the housing market is seemingly doing the best it's ever done? And I think there's two primary reasons for that, and I've talked about these reasons before on this channel, but I'm going to talk about them again because I think they're really important. They bear repeating. The first is, I'm pretty confident that the foreclosure moratorium and the 1.5 million serious delinquencies sitting on bank balance sheets, I'm fairly confident that that's negatively affecting bank lending morale right now. The fact that we have a huge surge in serious delinquencies because of COVID, and that banks can't do anything about these delinquencies for now, and they can't foreclose, that's making them really hesitant to want to lend to anyone who could conceivably enter the same situation. That's one reason, and that's really the ironic twist on the foreclosure moratorium, something that was meant to help low-income Americans and people who are disadvantaged because of COVID. Well, you might be helping certain ones, but you're screwing over everyone else, because anyone who has questionable employment history or maybe questionable credit, you are now out of the housing market, especially on conforming loans. But I think another reason that we need to consider, and might be the bigger of the two, is that banks know that this housing market is a bunch of crap. Banks know that home values are coming down very, very soon, and thus, as a result, they don't want to make many loans and mortgages at today's home prices, because today's home prices, if they go down by 20 or 30% over the next couple of years, the value and collateral of the bank loan is lower. And all of a sudden the loans become riskier. They need to get moved to a different bucket on the balance sheet. They need to hold more cash. If loan values go down, maybe get a new appraisal. And so banks don't want to end up in that situation either. So they're only making loans to borrowers that they know will repay the loan and pay the mortgage interest, even if home prices come down. And I just want to address one more question I think some of you might have. This was a question that I had going through this data is, how is it that home sales have still been fairly high even when mortgage lending standards have been really strict? That's one kind of another confusing aspect to this. And again, it goes back to the quality of the borrower. Over the last 12 to 18 months, the housing market has been fueled by a very high income segment of society. I've talked about this in previous videos. In fact, one of my first housing crash videos was on this topic. And basically, what's been happening is that highly qualified borrowers and buyers who might have been renters before all jumped into the market at the same time over the last 18 months due to the pandemic, right? All of a sudden, like being in an apartment in the city, that just became like not palatable. And so a lot of people who maybe would have bought sometime in the next 3 or 4 years was like, I'm gonna buy right now. And that trend meant that we actually had an overabundance of highly qualified buyers and borrowers all coming into the market at once. And that's what's enabled the housing market to maintain demand over the last 12 months, even with lending standards that are very, very strict. The problem is there are only so many of these highly qualified borrowers out there who are looking to move from renting to buying. At some point, the burden of sustaining today's record high home prices is going to get shifted to a lower income segment and a lower creditworthiness segment. And when that happens, and it's already happening, massive problems are going to hit the housing market. All right, guys, I hope you enjoyed this video. This was kind of a technical one. The mortgage availability index is not a number that a lot of people talk about, but I think it's really one that bears watching going forward just because of how different a picture it paints of the current housing market compared to what you see printed and reported everywhere else. If you guys enjoyed this content, I want to make sure that you're a subscriber. Roughly only about 20% of my views come from subscribers. I would love to get that number up. I would love to have you guys as a subscriber. So consider that. I have 3 of these data-driven videos coming out per week. Also consider joining my channel as a sponsor level member. The cost is $5 a month. You support this channel financially, and in addition, you get some really, really cool perks. There's a private community board here on YouTube just for channel members where I'll post exclusive graphs, exclusive data every single day. Additionally, I have polls asking you what my next video should be. So if you want that exclusive data and graphs and you want to have an input into what these videos are, become a channel member. There's a link in the description. All right, guys, until next time, this is Nick from eVenture Consulting signing off.